Good day, ladies and gentlemen. We are still busy with exercise 3.5, but at the completion of this exercise, we are given below a statement that we are to examine carefully, then answer the questions that follow below. Statement, it is the sixth statement, and we have very important the term, which is 20 years for the statement agreement. Then the remaining term is 191, and if that is 191, that means we can know how many payments are already made. That means we can know that 49 payments are already made, which also agree with this statement. So now let us then examine this statement very carefully. On the statement, we can see that we have a payment number, which is payment number 46, 47, 48, and 49. We have the description, which is the balance monthly debit. Remember, the monthly debit, it is the interest. I want to highlight that monthly debit is the interest. And remember, the interest is calculated on the balance at the beginning of the period. So this interest is calculated on the balance the client was owing at the beginning of the period. And also this interest is calculated on the balance the client was owing at the beginning of the period. And the interest is for the month, and it is added on the amount of the loan. But I'll show you the other difference between the inclusion of the interest on the payment or installment. Then we also have the interest, which is based on the balance the person was owing at the beginning of the month. Remember, beginning of the month is the end of the previous month. So I'm saying that cautiously, knowing that you are accounting students. You know that closing balance of the previous month is an opening balance of the current month. So now similarly, the interest there, which is the monthly debit, is calculated on the balance at the end of the previous month, or a balance after the payment of the previous month was made. So now we can see that the interest amount is changing, but the interest rate remains the same. Now you will see that when I do prove to you that the interest rate remains the same, but the amount of the interest is changing based on the balance in which it was calculated at. So, but you can see that there is an installment payment. The amount that the client is paying every month does not change, although the interest amount is changing, and the interest amount is decreasing year go by. So you can see that the interest was 1,553. Now in the month of the third month 205, it is 1,550, 1,004 or 547, 1,544. So we can see that the interest is decreasing month by month as the year go by, or the years goes by. So now we have simply analyzed that, but let us test now this interest. Remember, we said in the simple interest topic that to calculate interest, it will be interest divided by the amount, which is the balance, or interest is equal to I divided by A times by N. If you remember, we said interest as a rate is equal to the bigger I divided by amount divided by N. So now what does this mean? That means we will need to say we already do have the interest, which is the bigger I. These are the interest, the bigger I. And I will not be explaining simple interest in details. We dealt with that already. So now this is the bigger I. A is the amount in which this interest was calculated. And A is the amount in which this interest was calculated. And remember, this is for 1 month only out of the 12 months. So, but we need it for the full year. So now we need to multiply it by 12, because this interest is for 1 month, but we need interest rate for the year, but compounded monthly. So now again, this is the interest amount which was based on the amount at the beginning of the period. Now, meaning our interest for the month of February will be interest amount being 1,553.17 divided by the amount which is 162,070.42. Now let us just do this random calculation. 1,553.17 divided by the balance at the beginning of the period, which is the balance at which the interest amount was calculated at, using the interest rate that we don't know. Then we say 162,000 rands and 70 rand 42 cents. Then we have to multiply this by 12 because we need interest for the entire year, not only for the month. Then we multiply this by 100 in order for us to get to the rate. And we can see that in the month of February, our interest was 11.50%, which is 11.50 is our interest rate. Let's just test it in any other random month. Let us just take somewhere there in the month of May, where the interest amount was 1,544. You can test anyone. Then we can say now 1,544 rand, 86 cents divided by the balance after the payment of the fourth month was made, or balance at the end of the previous month. Then divide by 161,202 rand 91 cents. Then we say equal times by 12 because we need it for the entire 12 months in a year. Then we say multiply this also by 100 so that it becomes the full percentage of the interest. Our I is equal to 11.50. We can say that is consistent. Even if we can take this one at the end of the month of March, you need to take the balance at the end of February. You divide by that times by 12 times by 100. This will give you the interest for the full year, which is the interest that is being charged on this client. Now we have done a deep and careful analysis. Remember, this is the monthly payment, which is the installment that is being paid, or the premium. What does this mean? Now every month, remember, every month we pay this amount, but this is the agreed monthly payment for the next, or for the whole of the 240 months, which is 20 years, paying this 1,839 rand 59 cents. Now this is what we are paying every month, but our loan, it does not decrease with the amount that we are paying. What do you mean, Mr. Teacher? Because this is a decrease and our loan is decreasing by the same amount that we are paying. I'm not saying what I'm saying, but I'm saying what I'm saying. In other words, at the end of the month, remember what I'm trying to say, that the interest amount does not appear in your statement. The interest amount does not appear in your statement. So now, in other words, when you make a payment, they will shovel the interest there as negative, and you somewhere where you don't see. Maybe in some statements it might appear, but I just want to show you the net of the two. Now your payment is this amount, and now your payment will only decrease by the difference, meaning we have 1,839.59 minus the interest of 1,553.17. If you do that, this is the amount by which your loan will decrease by. Remember, this was the balance beginning of the period. So if we remove that, we can just say in this amount minus 208 1,086.43. Then the question is, why is our loan decreasing only by this amount? Let us first prove if does it really decrease by the amount that I'm writing, which is the difference between the interest and the payment. Now, if we say in that 160,000, we say minus 162,000, 070.42, we get to the balance of 161,784. Exactly the same amount, 161,784. Now, it seems like I have excluded that. In other words, what I'm simply saying is that the amount that you are paying is divided into interest and into repayment, meaning out of this 1,839, the total of 1,553 for month of February, it is interest. It does not reduce your loan. So we need to be very careful in terms of this understanding, because some of you listening here will highly to experience what I'm explaining when you get into buying assets on credit through finance by the bank. So this amount that you are paying, the huge portion of it, which is 1,553.17, goes to the bank as their income, which from the side of the client it is interest expense, from the side of the bank it is interest income. So your loan only decreased by a small portion, very, very small portion, that we prove to be 1,839.59 minus 1,553.17. So your loan only decreased by the difference between interest and the premium that you pay, which is the amount of 286 rand 42 cents. I'm explaining this for broader understanding, but when you go to third year, you'll see that this amount of the interest will be separated and it will be deducted from here, where now you'll need to know that 286.42 minus 286.42 minus that, then you'll know that, okay, this amount is the capital portion. This will be the capital repayment. In other words, this is the amount that is repaying your loan, 286. This is the amount of the interest. So at third year level, finance 3, you get to split these two. So please have this knowledge and keep it for the rest of your life, not only after you pass your third year. Now I've done my analysis in 13 minutes, then I can go to the answer that follow. Now, we are required, we already know the interest, remember, although they have not told us how much is the interest rate, which is 11.5%. Compute the original amount that was borrowed. How can we do that? We need to know the interest, meaning we first need to calculate our I. Our I is equal to 1,553.17. Just verify was the 17. Yes, remember you can take any of the interest, any of the months. 162 is 8 divided by 162,070 point or comma 42. Then whatever answer that we get here, we need to multiply this by 12. Then after we multiply it by 100, then it will give us our interest, which is our interest being 11.50. So our interest is equal to 11.50%, and it is per annum, compounded monthly. Please write all the calculations. I'm just saving space so that I can be able to complete this question here. We need to know the amount that was borrowed. Now, for us to calculate the amount borrowed, remember the amount borrowed is the present value. We need to know PMT, we need to know interest rate, we need to know our N. So we do know this plus minus 1,810. How much is our PMT? 1,839. 1,839 rand 59 cents. This is our PMT. Remember, PMT is a constant amount. Our interest, it is 11.50 divided by 12 because it's compounded monthly. Our earn is 240, the whole of the total 240 months, which is 20 years. What are we looking for? We are looking for the amount that was borrowed presently, which was presently, it was then 49 months ago. So now we can calculate in the present value of an annuity. You can use your financial calculator, guys, which is in the app. Calculating the present value. I don't know this app now because I have my Wi-Fi on and it automatically do this advertising. Present value of an annuity, you do your PMT and everything, but I'm not going to use the calculator, but you can download. It's very easy to navigate around it. So now I will be using my manual calculator where I have to say second function alpha 00 to clear the memory. We have 1,839 rand 59 cents plus minus PMT. 11.5 divided by 12 is my interest. 240 is N. Then I need to know how much was borrowed at the beginning in order to be repaid for 240 months, which is 20 years. 172,499 rand was borrowed with 89 cents, but that will be 9 cents rounding off in my calculator. So now this will be 89.90 cents. So this is the amount that was borrowed at the beginning. Please don't clear your calculator. Sometimes it's important not to clear until you read the next question, in the case where there is a build-up kind of questions like this one. Now we go to number R, or sorry, number Q. It says the interest rate increased to what? To 12% per annum compounded monthly. From which month? From the beginning of June 2005. So we need a balance at the end of May. We need a balance at the end of May. That means we need to say amount May, or amount payment number May, if I may say so, May 2005, because there are so many Mays that have passed. Let us look at our statement. We have payment number 49 at the end of May. So 31st of May, January, February, March, April, May. This is at the end of this payment, interest rate started to increase to 12% from 11.5. It went up by 5 basis points. So now or 50 basis point. Then now that is from economics, sorry for that. Now we are then now going to know the balance, or we need to know the balance after the 49th payment was made, meaning the interest increased to 12% after the 49th payment was made, meaning at the beginning of the 50th payment, which is beginning of June, is the beginning of the 50th payment. So that means we need to say amount. Now again, one will wonder, then what do we do now, because this question is a build-up of the previous question. So now because this is a build-up of the previous question, we then now we then now need to recalculate, but depending, either there's a necessity, but in this case there's really no necessity because we have calculated this already. So what we do, we just need to first say amount so that we know the balance after the 49th payment was made, of which from the statement, that balance, it is very clear. You can use amount if you want, but this balance, it is very, very clear. We can see that this is the balance after the 49th payment was made. Now, if you wanted to test that, you can say amount, you go to P2, you say 49, and you say enter, and you scroll down, and you will still get 168.0.18. So it's exactly the same if you wanted to prove or test that. So now this will be the balance after the 49th payment was made. So now this is the balance, we already have it. We did not have to use the amount function. In this case, don't use amount function when figures are already given to you. So now that means we can just use this balance to calculate now the new payments with the new interest rate. The new payments with the new interest rate. Now the new payments will be from the 160,908, which is the balance beginning of June 2005, 16908.18. This is plus minus 160,908.18 cents is our present value. Our interest, remember, now has changed to 12%. 12 divided by 12 because interest is compounded monthly. Our N will be 240 minus 49 because 49 payments were made and the remaining payments, remember, were 191. So it will be 240 minus 49 payments that we already made, because now on the 50th payment it will be at the new interest rate, which is 12% per annum compounded monthly. What are we looking for? We are looking for the PMT, meaning how much will be the new PMT after there's a change in the interest rate. So now remember, our N is 191. And please make sure that you don't clear your calculator after this calculation, because there might be a need for us to calculate using amount, meaning balance after a certain payment was made. 160,908 rand 18 cents plus minus is our present value. 12 divided by 12 is our interest. 191 is our N. Then we compute PMT. PMT amounts to 1,891 rand. This will be 91 cents. We can see that our payments now from payment number 50 will increase to 1,891.91 because of this increase in the interest rate. Then okay, if you look at the difference, then if you want, you can look at how much will be the increase in the PMT, comparing this and with that previous PMT. Then you can know how much now the new percentage have increased on the payments for this client. Then now it is 1,891 rand 91 cents. So this will be our new PMT. Now remember, don't clear your calculator. We're going to R, alphabet number R. Then after we go to alphabet number S, then we'll be done with this statement. Very, very easy statement, to be honest. Now it says the lender missed the payments number 55. Remember, this is payment number. Payment number. I'm thinking because I have to explain this. This is payment number 1. Okay, let me say it's payment number 55. But is payment number 1 in the new interest rate. Then payment number, this is payment number 50, not 55. This is payment number 50, which is payment number 1 in the new interest rate. It's the first payment when the interest rate is 12%. Then there will be payment number 51, which is the second payment in the new interest rate. Then payment number 52, which is third payment in the new interest rate. Payment number 53, which is fourth payment in the new interest rate. And payment number 54, which is the 5th payment in the new interest rate, meaning 1, 2, 3, 4, 5 payments were made in the new interest rate. Then payment number 55 was missed. After 5 payments were made, I want to highlight that. So payment number 55 to payment number 59, meaning 55, 56, 57, 58, 59, meaning 5 payments were missed. After 5 payments were made in the new interest rate. So when you say amount, we will not say amount 54, we'll say amount 5, because this is the new annuity at 12%. So I want to highlight this, guys, because it is very crucial and very crucial for you to master. Now, what does this mean? It means in the calculator that we did not clear, remember I said before we use a mod function, because now we need to know a balance after the 5th payment was made in the new interest rate, which is after the 54th payment was made in the entire period of the term of this contract. So now we know that for us to get to the balance after the 5th payment was made, when I'm saying the 5th payment, I'm saying the 5th payment of 1,891, which is supposed to be made for 191 months. So now that means we need to know that there's PMT in the calculator, there's interest, there's N, and there's present value, there's interest, there's N, and there's PMT. And in our calculator, as I said, don't clear, our calculator knows that we have present value of 160,908.18 at the interest rate of 12% per annum compounded monthly. That is supposed to be paid for 191 days, and this is the amount that is supposed to be paid. So that's what our calculator knows. So our calculator knows that our period of the payment of this amount is 191 months. We are speaking of the new annuity at the new interest rate of 12%. So now we need to say AMRT. Amount, what do we amount? We amount 5. Meaning 5 is the 54th payment. So now that will be amount 5. Then we need to know the balance after the 5th payment was made in the new annuity, or when there was a new interest rate. So now after we have used that amount, then I will get to a balance. I get a balance of 159,465 rand 49 cents. Now let me just go to your statement and just give you an overview of what I'm talking about here. Remember, payment number, let us just draw here. Payment number 50 is at 12%. Just want to say that, which is the first. Payment number 51 is at 12%. Remember, this one was, the previous payments were at 11.5%. Now, payment number 52 is at 12%. Payment number 53 is at 12%. Payment number 54 is at 12%. Not percentage there. Number 54 is at 12%. Now, in the new annuity, 53, 54, it's disappearing there. Payment number 54 is at 12%. Now we have payment number 1, payment number 2, payment number 3, payment number 4, payment number 5. We are speaking of payment number 5 at the new interest rate. We can say that we have a total of 5 payments. So hence we say amount 5. However, this is payment number 54. This is payment number 54. So we need the balance after the 54th payment was made, because the 55th payment was missed. Payment number 55 was missed. So there was no payment in payment number 55. Up to payment number 59, which is 55, 56, 57, 58, 59. That means we need to add interest for the next 5 months. So this is the balance after the 54th payment was made, meaning the 5th payment, in other words. Now, balance after the 5th payment was made. Then what do we need to do now? We need to say this is our present value, which is the 159,465 rand 49 cents is our present value. We need to add interest for month 55, 56, 57, 58, 59. 5, 6, 7, 8, 9 for 5 months, meaning our N will be 5. Because at the time you don't pay the bank for the months that you agreed to pay, the interest is added. So your loan is increasing. Then after we have our interest, which is at 12%. Remember, the interest now is at 12%. So the interest is added at 12%. So now at the number of years you don't make any payment, the interest is added. So now we need to know how much is the value of the loan after the 59th payment that was made, meaning before the 60th payment was made. So we are looking for the future value. Second function alpha 00 to clear the memory. 159,465 rand 49 cents is our present value. So now we have that as our present value. Then we say plus minus our present value. Then after we say now our N is equal to 5, our I is 12 over 12. Then we have 5 as our N. We have our 12 divided by 12. If you want, you can say 1 is our interest. Then what are we looking for? We are looking for the future value. We are looking for the future value. This is our number R. Future value is 100. Let us just verify that 154,000.49. Yes, it is our 167,599 rand 83 cents. So that is what I get for my future value. This is what the client owes at the end of the 59th month, which is the last month when he missed the payment. Now, on the 60th month, then now he starts to make the new payments. Remember now, if we say it's the 60th month, then we need to go back now and say the 60th month. We remember we had very important, we had 191 that were remaining. Then we said out of that 191, 5 payments were made. Remember that 191 was from the previous calculation at 12%. 5 payments were made, which was payments on payment number 50, 51, 52, 53, 54. So 5 payments were made. Then we need to say 191 minus 5 payments. Those payments were made. Then other 5 payments were missed. Then you can still say minus 5 payments that were missed. Minus 5 payments that were missed. Then now the question is, how then many months are left? That is where we're going. That means we have 181 months that are left, meaning now that payment number 60 will give us 181 remaining, which is the same as 240 minus 59. This gives us 181. Either way you do it, it doesn't matter. You can do it from the total period or from the changed period. So now, in other words, I'm saying we then now need to calculate now based on what we are required, the new payments starting at the end of month 60. The new payments at the end of month 60. So now we say plus minus our future value become the present value, because this is what the client presently owes. 167,599 rand 83 cents is our present value. The interest, remember, is 12 over 12. And again, if you want, you can just say 1. 12 over 12 is 1. I don't want to keep you with the same boring stuff. And our n is 181, which is 240 minus 59, or else 191 minus 10. So that will still give you the same 181 as our n. So now what are we doing? We compute PMT. How much will this client now pay since he missed 5 payments from month 55 to month 59? 167,000. This is 167. Just combine that as R. 167,599.83 plus minus is the present value. 12 over 12 is our interest. 181 is our I. Then we're computing, or we're calculating the amounts of the payments. So our PMT is changing to 2,007 rand 50 cents. The more you miss the payments, then the more premium will increase, or your premium will increase when you start resuming to the new payments, unless you want to change the term of the agreement. Now, we have dealt with the PMT that has to change because of the missed payments. And guys, I want to highlight this once again. Every time there are missed payment, you need to know the balance a month before the missed payment, which is the balance after the 54th payment was made. There we go. The balance after the 54th payment was made. This is what we did. We took the balance after the 54th payment, which was payment number 5. I want to highlight also that because there was a change in the interest rate, meaning in the new interest rate, it was the 5th payment. The minute to determine that balance, you take that balance, which in this case it is 159,465. You add interest, meaning you say this balance is now the present value. You add interest for the number of times the client missed payments, which is in this case was 5 months, which is month 55 up to 59. Then you get to the future value. Therefore now from that future value, the client wants to resume payments at the end of month 60, meaning a month following the last month of the missed payment. Therefore now you start again, calculate the new PMT, taking that future value to say, now this is what you presently owe client. You are owing this amount, which is 167,000, and the remaining period is 181. The interest rate is the same. Therefore now your payments will have to increase because of the missed payments. So now this will be the scenario where the client wants to still keep the same period. Then after we go to the last part of this question of the statement that was provided to us. Then now it says alphabet S, assume that the lender borrowed a further 50,000 at the beginning of month 65. What do the payments increase to from the end of month 65? So now at the beginning of month 65, the person borrowed another money which amounted to 50,000 rands. So now the minute there is a change in an annuity, we need to determine a balance at that point in time. In this case, we need to know a balance at the end of month 64, because the borrowing took place at the beginning of month 65. The closing balance at the end of month 64 will be the opening balance at the beginning of month 65, so that we add the amount that was borrowed and start calculating now the new PMTs at the end of month 65 after there was a new borrowing. Now we need not to be ignorant or forget the fact that the interest rate increased to 12% per annum compounded monthly from the beginning of the month of June 2005, which was also highlighted also here that the interest rate was increased on the 1st of June, so we needed not to be ignorant of that. So now, and we did take that into consideration. Now, also here, we need to take that into consideration. What does this mean? It means we need to know the balance after the 65th or after the 64th payment was made. Now, we are, remember, in the new period. In the new period, where now the interest rate is at 12%. And that means we did explain this in details, and it will be very good for me to go to the statement again now when it comes to this. That means in the new interest rate, which is starting from payment number 50, where the interest rate is at 12%, we need to say from 50 up to payment number 64. How many payments do we have there where 12% was made? Because we need a balance after the 64th payment was made. But we need to know what payment number is this at the new interest rate. So now we know that this will be 1. So now we need to say it goes up to 64. It goes up to 64. And if this goes up to 64, we need to know that starting from 50, excluding 49, then we can say minus 49. So that means we have to say 64 minus 49, 15 payments. We need to amort 15. We need to say amort 15 after we calculated now the new PMT that we previously calculated. Meaning now we need to have our N as 15. Our N will have to be 15. But we first need to do the recalculation. Now, let us go there and do the calculation of number S. Then what we need to do first is to enter the data first, starting here, because the interest rate changed at the end of this month. So we need to enter the data which we previously did to get to the amount that was initially borrowed. Then not the amount that was initially borrowed, to get to the PMT for the remaining 191 days. Where was our PMT? Yes, we need to enter and get to this data, starting from 160,000, where there was change in the interest rate. Then we compute the PMT. Then after computing this PMT, then I will be using amort. Then our amort will be amort 15, meaning balance after the 15th payment was made. That is what we'll be looking for. So let us go there now and we do that calculation. Zapita can't use the app. Then we'll have plus minus 160. It was 160,908.18. This was our present value. Remember, this was the present value at the change in the interest rate, when the interest rate was changed to 12%. Then our N was 191. Then we compute PMT. We need to know how much were we paying when the interest rate was at 12%, because this person borrows 50,000 rands at the beginning of month 65. Remember, the interest rate at that point in time is at 12%. So we need to calculate now. We need to have our PV in our calculator, and we need to have our interest and our N and our PMT. The minute we have our PMT at the period of 12%, when this person borrows 50,000, then we'll be able to say how much was the balance just before this person borrowed the 50,000 rands. So that is where we are heading. So we're just recalculating that. Otherwise, there will be no mark for such, and it will be in one question, to be honest. So let us say 160,908 rand 18 cents is our present value. 12 divided by 12 is the interest. 191 is our N. We're calculating our PMT, and our PMT is 1,891 rand 91 cents. So our calculator knows all these four functions now. The minute it knows all these four numbers or components, then we can say now we want to know the balance after the 64th payment was made, because the 64th payment was made at 12% when the premium was 1,891. So now hence we can now be confident to say amort 15 equals. We need to know the balance after the 15th payment was made. Then I can say amort 15 under P2, enter, scroll down, I get 156,355 rand 58 cents. So this is the balance after the 15th payment in the new interest rate was made. I want to highlight this. Remember, the 15th payment is the 64th payment in the total period, but in the new interest rate, it is the 15th payment. Because payment number 50 is number 1 in the new interest rate, then 51 is 2. So that is why now payment number 64 is the 15th payment in the new interest rate. This is very important, guys. I don't know how I can stress it out, and I hope you understand it. Now that we have cleared this, we got this balance. At this point in time, this person is adding another loan and is adding 50,000 rands to the account. Now that is adding 50,000 rands, we need to calculate now the new PMT, because this is a balance after payment number 64 was made. Then it's going to make payment number 65 after the borrowing of 50,000 beginning of the 65th month. So now that means we will have to say the balance plus the interest, and then we say 156,355.58 plus 50,000 rands. This will give us the balance after there was funds that we borrowed, which is 206,000 rands. 206,000 rands, 355.58. This is the balance that is in the account. Then we need now to calculate our new PMT. Then let me just take this balance and we start on the new page because of the limited space. Then we say plus minus 206,355.58 is plus minus our present value. Interest, remember, is still at 12%, and our N will be 240 minus, if you want, you can say 191 minus 15 or 240 minus 64. Just verify that. 240 minus 64, it will be 176, or as in the new period at 12%, the remaining period was 191. And we know that 15 payments are made, then it will give us 176. So either way, you still get to the same amount. Then what are we calculating here? We are calculating the new PMT. Calculate PMT. Calculate PMT. Then we say 206,355.58. That is plus minus present value. 12 divided by 12 is our I. 176 is N. Then we calculate PMT, which amounts to 2,496.91. With that, guys, you've been wonderful, and it's very important to master the dynamics of this question and the one that I did, where there are missed payments, where there is a change in the interest rate, and now you need to amort a balance after there's some payment number something. So we need to know in the new annuity, that payment number is payment number what? And also can consider the total of the old period depending to how you want to do it. But it is very important to master this because it will definitely be tested. With that, guys, you've been wonderful. Thank you very much once again.